Laurance, and I'm here with Sterling Pratz today from Car IQ. Thanks for joining us today, Sterling.
Hi, Allyson. Thanks for having me.
It's been some interesting times thinking about the different payment ecosystem, and particularly the ecosystems. I guess when you think about, changing mobile payment experiences, voice, and face-to-face. And I think some of looking at the connected ecosystem around IoT and kind of breaking down those barriers across the experiences. So it's kind of like driving a seamless commerce journey in the back end. So it's why I'm particularly interested in having you today to give a bit of background about yourself and what you're doing at Car IQ.
Yeah, thank you. Appreciate it. Look forward to it. Always fun to chat about cars and payments, I guess, at the same time we have in common. So where would you like to start?
Well, I think you've got an interesting history. Give a bit of background there. And also maybe for those who don't know, what are you doing at Car IQ?
So I'm the founder and CEO of Car IQ. We've developed a payments network for cars that allows cars to connect any bank or any merchant and pay for services autonomously. No cards, no humans, strictly the vehicle.
Got it. And so it's interesting you mentioned that. I think we were talking earlier, we have a theme that we're exploring with clients, kind of called what I call the thing economy. So we think payments will be tied and intricately linked to the rise of machines, right? And so we think about the proliferation of data and real-time expectations, right? And instantaneous expectations. So pushing more of that to the edge. So more payments happening closer to the consumer, closer to the corporate. How, in what is traditionally now very much of a human-originated or human-led payment arena, how are you rethinking transactions for when it's coming as a machine-led endeavor?
Yeah, absolutely. We spent a lot of time thinking about this. We started the company in 2016, and the whole goal was, the future of transactions we felt were going to be machines. There were already at that point hundreds of millions of machines connected to the cloud asking for service. And we thought, how cool would it be if those machines could not only request service, but pay for service? And we saw another interesting thing too. We saw that cars were predominantly connected. More than 85% of cars coming off assembly line had a connection point in them. And so with my background of automotive and payments and stuff, it was sort of a natural, nice mix between the two. But it also was a difficult one. When we started thinking about what a transaction actually looks like, we at first thought about it from a human perspective. And people swiping cards and using card present or some sort of e-commerce platform like PayPal. And what we recognized that a machine payment actually wasn't anything like that. There was no human element to it. It had no commonality with how a human applies, authorizes, and receives a transaction and then pays for that transaction. Nor did it have any similar qualities to how e-commerce works. So the idea of how you transact over your computer or a mobile phone. And what we recognized was the processes were, quite honestly, they were human-centric. So every bank, every payment network in the world, as you know, was using a process called KYC. And they were using it called Know Your Customer. And that's their form of identity verification. And we felt the problem started there. That if we can't develop a better understanding and a better way to create identity verification that a bank will trust, there was no way to make this happen.
So, you raise a good point. I think there's a lot of obviously problems now with even assuring trust and security from a KYC standpoint.
Yeah.
So flipping it over to that KYM, Know Your Machine, how are you building in the security and the trust around that verification piece? And if you're thinking that payments will be directly linked to a rising machine-led front, are the ways that you're assessing KYM leading to best practices for the industry overall?
Yeah, absolutely. The first problem we had to settle was, well, KYC processes aren't good enough, but why? And what we realized was human-centric processes such as KYC were very focused on who the person or the accounts the person is associated with. But when a machine transacts, there's no human, so there's no accounts technically to associate. And what we realized is the difference between the two was machines, you had to start looking at what the machine is comprised of versus what accounts it's associated with. And we started realizing that you could use the data inside of a machine, and you could take strands of that data and you could compile that data and create essentially a fingerprint for the machine. And that fingerprint can then be used to communicate directly with the bank or the merchant in a manner that the bank will trust. So today, for instance, we invented and patented this process called, as you mentioned, KYM, Know Your Machine. Couldn't think of a better name for it. And inside that process, we create an ID and our identity for the machine. But we don't stop there. We realize that that's not enough. Like a bank such as Citibank would never trust just simply a fingerprint. What we realized is we had to add into that the communication path with the bank. We had to add all the banking and regulatory compliance so that the bank could trust that that transaction is not only that machine and who it says it is, but it's following the regulatory requirements and the banking requirements to transact on top of it. And that became KYM. And that's why the process doesn't look anything like a human-centric process today.
Now, I'm assuming there's a lot of obviously different IoT instances and the ways that they're validating coming from a machine. Do you know how your KYM process compares to other instances of industry in doing that? Are there a lot of variances there, or do you find that you're kind of normalizing across that front?
We're starting to normalize. We're starting to see other banks adopt our process to trust a machine to transact. We're definitely seeing merchants adopt our process to see transactions, and that can range from, so today we have cars transacting for fuel. So on-demand fuel, we're getting ready to deliver pay at the pump. So imagine you can drive into a gas station, the car will automatically sync up with the pump, allow you to put gas in and just simply pay. But we're also seeing other things now. We're seeing cars transact for tolling, for service center, so it can drive into a service center and pay for service. And that is starting to help us mainstream with the process.
And maybe talk about a little bit about data. We were talking that more proliferation of data on the data front is giving a lot of rise to payments coming from machines. Mm-hmm. So the data that perhaps you're collecting in the midst of a machine transaction, how different is that what you see from a normal payment flow? And do you see that leading to a lot of better or augmented customer experiences from dealing with a seamless machine-initiated interaction?
Yeah, absolutely. There's a couple things we see. One is on the identity side to support the transaction. And then we think that the data that you pull from the machine can not only enable you to have a more precise transaction, but you could offer other services on top of it, such as rewards programs. So from an identity perspective, we see things that you don't see in a human transaction. So we see things like, hey, how big is the gas tank? How much fuel does it have in it? And we tell the merchant and the bank exactly how much fuel the car is capable of receiving in this transaction. And we think that's really important for two reasons. One, it's important to the merchant to prevent fraud, because now they know that car is who it says it is. It's capable of paying for a service and it needs that service. And then we think it's really important to the bank. Today, banks underwrite, from a treasury side of the business, they underwrite trillions of dollars every day. When you swipe a card, they automatically will reserve an amount of money to support that transaction. But because they have no visibility into the transaction, they have sort of a block amount that they reserve. Fuel, for instance, is about $100 to $125 per transaction, even if the car only needs 1 gallon of gas. But in our case, we're starting to use that data to change that communication and that relationship. The relationship is now starting to change where we will tell the bank and the merchant that this car has a 10-gallon gas tank. It has 5 gallons of gas in it. Therefore, it only needs a maximum of 5 gallons. And the merchant knows the risk and they can prevent that fraud. But the bank can underwrite only 5 gallons worth of fuel versus $100. So they'll end up underwriting maybe $22 versus $100 to $125. And if you take that on scale, that's a massive improvement on all perspectives. And the second part to your question, I think is the most interesting one. We're now seeing that when a transaction happens, you're not only seeing the transaction and matching it to the identity, but you now know everything about that transaction. How many miles are on the car, which direction the car came from, the last time it purchased fuel. You'll know the next time it's going to purchase fuel, right down to the mile. But you'll also know other things like what's around it. So if they're going in to get gas, is there a Starbucks or a McDonald's right nearby? And that means, could you present an offer to that customer? Because findings will show that customers have a high likelihood of going from fuel stations to food or some sort of service. And you could present an offer to them to encourage them to go from the gas station to that service or that storefront. And those are things that you can't really do very well today.
So a lot more data nuances you can gather because the machines are enabled to pick up a lot of other points that maybe traditional payments aren't today.
Yeah, I mean, payments companies and even Google, to be honest, we're seeing that, Google's all based on intent to purchase, right? They have all your historical information that you're likely to purchase from Nordstrom's or from Starbucks, but they don't know what you're going to purchase next. They can only inference that. But in our case, we can tell them exactly who you purchased from prior, your likelihood to purchase from them again, and exactly when you may purchase a specific item. And that we haven't done anything with that information yet, but we already can see it, so we know it's valuable. And it's kind of fascinating when you look at it, you see the strands of information, you realize, oh, this person bought 15 gallons of fuel and they consistently buy 15 gallons of fuel at this ratio of time. Therefore, we know exactly when they're going to need fuel again. And we can track the mileage and know exactly when they're going to need something. And oh, by the way, since we can see their odometer, we know when they're going to need brakes. We know when they're going to need tires. We know when they're going to need oil change. So that kind of information now is really going to support the merchant in the banking category more than anything. But I think it's going to provide conveniences to the car owner or the driver that they haven't seen before as well.
I'm sure all that data gathering and aggregation is on your roadmap then, and how you're actually going to get that up to the right merchants.
Yeah, it's definitely the area we nerd out the most on. There's a lot of nerding out when you see this type of information. Some of it I'm like, oh my God. But it is fascinating because it's not just math and numbers. It's human behavior is associated with these transactions, and the machine is the one initiating it. And I find it kind of fascinating.
Well, I think it also, maybe to a final question here, the rise of ecosystems, right? And we were speaking a little bit on this, where we have a theory also on, well, not a theory, I think it's pretty much probably trite language at this point, about embedded finance. So not traditionally non-finance players embedding payments within their ecosystem to continue building on those network effects. And so if I think about it, the likes of, when going back to different payment experiences, changing voice payments, so Alexa and paying via voice in cars, so keeping consumers in an Amazon world within Amazon, whether they're driving. Do you consider it a bit of a race then between the big tech advancement and other ecosystem forays like cars and manufacturers versus an IoT, such as an OEM led IoT payment play?
Yeah, absolutely. I think the race is on to provide a better service, right? And a more seamless payment experience. I also think the race is on to combine experiences. So we're seeing right now, working with auto manufacturers and with large fleet operators, the desire to not only order something through your car through Amazon or Alexa as your interface, but to also add other services to it. The OEMs, for instance, are very interested right now in how do we move from payments, so cars paying for tolling or fuel or anything like that, and can we add that into the loan of the vehicle? So essentially the vehicle has its own P&L, and can we create the ability to not only have a financing period with the car that is all about the car, but could we add 6 months of fuel with it or a year's worth of tolling inside of that loan as an incentive to purchase that car? And what's unique about what we're doing is when you think about the connection between data and the transaction, you're tying the two together, and that's never happened before. And when you tie the two together and the purchase emanates from the vehicle, it technically falls under Monroney laws, meaning anything that's associated with the car cannot be taken from the car. That's a law. And how we're rethinking the transaction is much different. We're saying, hey, if the law says anything that's associated with the car is part of the car, then why not add fuel or tolling or things that only the car can trigger and pay for? And therefore, that loan and that payment goes with the loan, the length of ownership of the vehicle versus just simply the loan of the vehicle. And we think that's going to open up a lot of opportunities to add services to the vehicle that when a customer purchases. We also think that's going to really open up vehicle financing and rethink how loans happen and how lending happens. And we know it's going to definitely help people rethink what's their relationship with their customer while they're in a loan or financing period. The number one thing is simple. Vehicle loans are typically 36 months, and then you have to replace that customer with another new customer, another new loan. But if you have fuel and tolling associated with it, or you could go back and offer other services that fit into that platform, now your relationship with that customer is over the term of ownership. And that's typically 7 to 11 years. And I think that's powerful.
So it sounds like you're thinking of broadening an ecosystem beyond just a consumer interaction, where the whole consumer lifespan that is tied to whether or not it's that individual car, but their whole interaction with that ecosystem around driving.
Yeah, absolutely. Like today, every car company in the world or every major car company in the world is really exploring how to become a services company. One senior executive that I have the utmost respect for in one of the large car companies told me one day, I shared with him what I was thinking and doing with Car IQ. And he said, that's amazing. He said, that's something I think every car company is going to want. And it's simple. He said, selling cars is $1 billion business, but selling services is $1 trillion business. And then when he started thinking about payments associated with it, he felt that was even bigger. But more importantly, he thought about payments from a structure of, hey, this is a way to develop a better, closer relationship with our customer than just simply offering them a service. And that's really, 3 years later, that's really starting to show.
Well, it's exciting to see the work you're doing, particularly your recently announced partnership with Discover. I know you're chatting about it on Manifest Live. So excited to have you on today. Thank you for joining and sharing insights, and we'll chat soon.
All right. Thank you, Allyson. Appreciate it.
Thank you.